From private credit to programmable credit, how crypto rails are becoming the cleaner path to bank yield. Flint West reporting. They'll tell you banks are conservative. They'll tell you banks hate risk. They'll tell you banks just want safety, stability, prudence. That's not true. Banks don't hate risk. Banks hate visible risk. For decades, modern banking has been trapped inside a contradiction. Regulators demand safety, shareholders demand return, and the balance sheet can only stretch so far before someone starts asking uncomfortable questions. So the industry did what it always does when the rules tighten. It adapted sideways. Private credit wasn't born because it was elegant. It was born because it was convenient. A way to keep yield alive without keeping risk close. You don't hold the loan. You finance the fund. You don't price the risk daily. You value it quarterly. You don't explain the exposure. You explain the structure. 1 degree of separation. Just enough distance to keep the regulators calm. Just enough opacity to keep returns flowing. Private credit became the shadow limb of the banking system, a place where risk could still breathe as long as it stayed out of sight. And for a while, it worked. But opacity compounds, correlation hides, liquidity lies. And eventually, someone notices the shadow is getting bigger than the body. That's the backdrop. That's the constraint. That's the world banks are operating in. Now enter crypto. Not the casino version, not the meme-driven nonsense, not the speculative froth. The rails, stablecoins, on-chain settlement, programmable logic, deterministic execution. At first, banks laughed. Then they ignored it. Then they tried to wall it off. But something changed. Not culturally, regulatorily. Basel didn't bless crypto. It dissected it. It said, some of this is junk, some of this is toxic, and some of this, if it meets strict conditions, behaves more like cash than chaos. That distinction matters. Because once you stop treating everything as radioactive, you create room for structure. And structure is where banks live. At the same time, the perimeter moved. Stablecoin issuers didn't stay offshore. They didn't stay informal. They walked straight into the regulatory core. Trust charters, limited banking licenses, federal oversight, not to become banks, but to become bank compatible. That's the shift most people missed. This wasn't crypto asking for permission to speculate. This was crypto volunteering to be infrastructure, and infrastructure changes incentives. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Because stablecoins were never about yield, Circle earning interest on reserves is irrelevant to banks. Banks don't hold settlement systems for carry. They hold them for control, speed, optionality. Stablecoins are not investments. They are operating systems. They settle instantly. They never sleep. They don't care about borders. They don't wait for business hours. They don't require intermediaries to agree on timing. And once money behaves like software, credit stops being paperwork. This is where the real transition begins. Private credit hides risk behind structure. Programmable credit expresses risk through code. Collateral is visible. Rules are explicit. Liquidation is automatic. Exposure is continuous. No quarterly marks, no valuation theater, no trust us decks. Risk doesn't disappear. It becomes legible. And that's the upgrade. Because banks don't actually want less risk. They want better risk accounting. They want to know at all times what they're exposed to, how it behaves, and how fast it can unwind. Private credit can't offer that. It was never designed to. Programmable credit can, not because it's perfect, but because it's observable. This is why the comparison matters. Private credit is a workaround born of constraint. Programmable credit is an architecture born of capability. One hides fragility, the other surfaces it. And no, banks are not about to ape into permissionless, decentralized finance pools and prey. That's not how institutions move. What they're building instead are controlled on-chain environments, permissioned participants, regulated counterparties, on-chain logic with off-chain governance. The same discipline, a better substrate. Yield doesn't come from magic. It comes from capital meeting demand. What changes here is not the existence of yield, it's the path to it. For the first time since 2008, banks are being shown a way to pursue return without outsourcing risk to the shadows, without pretending distance equals safety, without needing a 1 degree of separation excuse. This is not deregulation. It's re-architecture. Private credit was the best answer in a world of blunt tools. Programmable credit becomes possible in a world of precise ones. And that's the real statement. Banks are not embracing crypto. They are upgrading their risk machinery. They are moving from obscured balance sheet gymnastics to explicit programmable financial logic, from hidden risk to expressed risk, from workaround finance to infrastructure finance, from private credit to programmable credit. That's the shift. And once you see it, you can't unsee it. Flint West signing off.